Should I buy a fund or should I buy an ETF? In this video, we'll look at the differences and the consequences of choosing one over the other, but also how the differences came about and how the best choice is tied to your investment platform. And I'll end with which I consider to be the best. Now, if you do enjoy our content, please like this video and subscribe to our channel. So what is the difference? Now, perhaps the best visual metaphor is to think of the core of the fund as being the index it tracks or its investment strategy if it's actively managed. That's what drives the return. So whether it's wrapped as a fund or an ETF, if it's a FTSE 100 tracker, that tells you the risk and return of the fund. However, there is a nuance here which can affect your long-term returns, because the legal wrapper, whether it's a fund or an ETF, determines the holding fees, the pricing of the fund, but also how the fund is traded and how it's taxed. Now, a big driver of the move towards ETFs in the United States is to do with taxation. Now, that doesn't apply to UK funds because the way we tax funds isn't driven by whether they're wrapped as an ETF or not. But it does have important consequences, as we'll see. Just to make sure everyone understands this, let's just briefly touch on fund types. Now, if a fund is passively managed, it tracks an index, and we'd call it an index fund. And there are many types of index fund. They can be wrapped as an exchange-traded fund. They can be wrapped as an open-ended investment company. That's what we mean when we use the shorthand fund. It's an OEIC, or an OIC as it's sometimes called. Another name for that, which is synonymous, is ICVC, which is an investment company with variable capital. And then the final type of index fund, which isn't so widely used anymore, is a unit trust. There are still unit trusts available, but I'd say they're on the way out. So all three of those are index funds, regardless of the wrapper. So index fund refers to how the fund is managed. Those indices are published by companies like MSCI, S&P, or it might be a company like FTSE Russell, for example. Now, all of those are open-ended funds. If money floods into the fund, then they'll go out and create more units of the fund. If money floods out of the fund, then units are destroyed. And then finally, we've got closed-ended funds where the amount of capital isn't variable. So in the UK, that would be investment trusts, which are actively managed, usually quite high fee, and those trade like companies on a stock exchange. Now, another key point here is that you can have actively managed ETFs, but also actively managed funds, or OICs or ICVCs. So the wrapper doesn't determine whether it's actively managed or passively managed, but if it's an index fund, then yes, it's passively managed. Now, the choice of fund or ETF affects how the fund is priced and traded. So here's an example of an exchange-traded fund, and if we were to zoom in on this, and we're really going to zoom in tight here, we can literally see the minute-to-minute change in the price of the fund. So let's zoom in on a day in February of 2025. And this is the intraday pricing of the ETF. It changes minute to minute. I could zoom in even further, and yes, you can see that the price is ticking up and down all through the day. This is just a 5-minute period that you can see here, for example. Now let's do the same thing for a fund. This is a global equity income fund from Vanguard. If we zoom in over a very short period of time, notice how we can no longer zoom in on intraday pricing. Now, the reason for that is that if you've got a fund or an OIC or an ICVC, however you want to name it, it's only priced at the end of each day, whereas an ETF is priced minute to minute. Now, as a long-term investor, I don't really care about that. But if you're the kind of person who'd like to trade in and out of a fund during the course of the day, well, you simply couldn't do that with a fund. So just for absolute clarity, when I talk about funds for the rest of this video, I'm going to be talking about OEICs. When I talk about ETFs, it's unequivocal, it's exchange-traded funds. Now, a difference you won't see when you buy and sell one of these ETFs or funds is that the way it's actually traded is quite different. If you buy an ETF, then your broker, your investment platform, will trade it via brokers on an exchange, the London Stock Exchange, for example. That's where ETFs are traded. That's where the word exchange traded comes from, the ET, the first two letters of the acronym. In contrast, if you buy a fund, then that has to be transacted directly with a fund manager. Now you can imagine that for the platform, that's a lot more work. They'd have to interact with many different systems, many different fund managers, whereas if they're transacting on an exchange, it's all standardized and quite easy. So I suspect that's the reason why some platforms charge you more to deal with funds than they do with ETFs. Another very noticeable difference between ETFs and funds is something called share classes. So for example, if we look at the popular Fundsmith Equity Fund, you'll see that there are many different share classes. You'll notice that those trade in different currencies. There are some in euros, dollars, some in sterling. And also what's really quite perplexing, I think, is that the charges, the expense ratios for those different variations of what is the same fund are quite different. Now some of those will be retail share classes, which you and I can buy, and some of them will only be available to institutional investors like pension funds. So I think this adds additional complexity, and as all of you know, I hate complexity. Now it's true that usually there's a primary share class. For example, for this very popular HSBC FTSE All World Index Fund, a lot of the PensionCrafters own that, and that's because it's a very low fee global index fund. The primary share class, which you can see here on ShareScope, has a P next to it. That's the accumulation share class, which is class C. But I think this is one of the benefits of exchange traded funds, which is you pay the same fee regardless of where you trade the ETF. There is no special discount which makes one platform sticky. For example, if there is a platform which has a special share class with a discount, then suddenly it messes up this whole concept of being able to cleanly move from one platform to another. Because then you have to start thinking, well, is that share class available on the other platform? And I think a lot of people are just confused by this. So that's why I think ETFs are simpler. No share classes, and if there is a difference, an accumulation version or perhaps a different currency version of the fund, I think that's easier to understand. What's key is that the fee is the same everywhere. Now before we go on to talk about the holding fees on different platforms and which I think is best, funds or ETFs, let me quickly mention the weekly market roundup. Now we publish this every Friday. We will not spam you with lots of irrelevant emails. And this is a great way to keep up to date with what's going on in macroeconomics, but also in markets, and also to learn about how the two interact. Plus we try to make it humorous, so we've got great puns that we really pride ourselves on. For example, yen and the art of business cycle maintenance, one small step for man, or an eye for an eye. I think the humour makes it more palatable and a great way to learn about investing. So if you're interested in that, just go to our website pensioncraft.com/newsletter to learn more. Now let's think about holding fees on different platforms, because these do vary widely. So remember that the fees that you pay when you buy a fund are the management fee for the fund itself. That's not massively different between ETFs and funds. But then there's also a holding fee on some platforms. You pay a fee simply for them to hold it for you and to tell you what it's worth and to also give you the ability to sell it eventually. Now the new generation of platforms in the UK come with no platform fee whatsoever. For example, Trading 212 and InvestEngine. Now those are ETF only platforms, and perhaps by avoiding funds altogether, all of this complexity about how they're traded with individual fund managers goes out of the window, and perhaps that's one of the reasons why these ETF-only platforms are cheaper. Whatever the reason, I think it's very compelling to have no platform fee at all. And I'd be quite willing to forego the ability to trade funds at all in order to get that fee lower. So I think this is a really interesting option, particularly if you're not really wedded to the idea of having funds. Other platforms in the UK are flat fee. In other words, you pay a fixed monetary amount every year, and for people who have very large amounts invested, that makes economic sense. Now I'd count Vanguard as a flat fee fund because it's capped at $375 a year. So once you hit that cap, you don't pay any more. Now on these three platforms, so that's Interactive Investor, iWeb and Vanguard, they treat ETFs and funds exactly the same way in terms of holding fee. You won't pay an additional flat fee if you have one or the other. So if you are on one of these platforms, then it really doesn't matter which you choose. Now, there are two UK platforms where it matters a lot which you choose, and the first one of these is Hargreaves Lansdown. So let's say you've got an ISA on Hargreaves Lansdown. There's a cap as to how much they'll charge you if you hold ETFs, and that comes out at £3.75 a month or £45 a year. So if you stick to ETFs on Hargreaves, that can be very cost effective as a platform. However, if you choose funds, then they charge a percentage fee. Now, for low amounts invested, that can still be competitive. But if you do invest large amounts, that percentage fee, which is not capped, can be massively more expensive. And of course, many of the people I speak to do have very large amounts invested. So switching from funds to ETFs on Hargreaves makes a huge amount of sense for those people. Now, it's probably worth mentioning that the dealing charges are also different for ETFs and funds on Hargreaves. This is true of a SIP or an ISA, and you can see at the top here there's no fee for dealing funds, open-ended investment companies, but there is a fee for trading ETFs. The actual fee depends on how often you trade, but of course you can control this. The less you trade, the less you'll pay. If you have a SIP on Hargreaves, again there's a difference between ETFs and funds. Here the cap is higher, it's £200 per year. But it still makes sense, I think, to buy ETFs if you have a large amount invested. There's a massive difference in fees between the two. Another platform where this is true is AJ Bell. Here you can see their pricing on their platform. And again, because exchange traded funds are effectively like shares in the way they're traded, there's a cap on how much you pay in fees, and this is capped at £42 a year in the case of AJ Bell. For funds, you can see they charge a percentage, so it's 0.25% up to 250k, 0.1% above that, and then above 500k there's no charge. But the logic here is the same as Hargreaves, which is if you have large amounts invested, it's probably best to stick to the capped fee for ETFs. If you use Dodl, which is the new offshoot from AJ Bell, you can see that there's a flat fee of 0.15% across any type of fund. And that's whether it's an ETF or an OEIC. And finally, let's come on to Vanguard, because it's a platform I've used for years now, and it does say something interesting here. It says that ETFs are generally cheaper to run than regular funds, OEICs, and often come with a low ongoing fee. We call this the ongoing charges figure. So it is interesting that they know that it costs more to run a fund than an ETF. However, if you actually compare the fees, I don't find massive differences between the two. Now, what is true is that some people like to trade on a live price. And as we've seen with ETFs, that is possible. So on Vanguard, they give you that ability if you're willing to pay $7.50 per trade. Personally, I'm quite happy for them to aggregate my trades with those of other people and for the trade to take longer. As a long-term investor, 1% either way doesn't make a huge difference to me. But as a Vanguard user, I don't mind whether I've got exposure via a fund or an ETF. The holding fee is the same for either. And of course, that holding fee is what's caused a lot of anger recently because it's now got a minimum of £48 a year. For small accounts, that can be much more expensive. And so finally, let's consider which is best. Now, it's pretty clear that the direction of motion in the fund industry is away from funds and towards exchange-traded funds. New ETFs are being issued every day, and that's true in the UK as well as the US. So if you do want to pay the minimum in fees, it's pretty clear that you'd go for one of these ETF-only platforms where there's no platform fee at all, platforms like Trading 212 or InvestEngine. However, not everyone's able to access those platforms. Perhaps your workplace insists that you use one of these legacy platforms. So if you are stuck on a platform like Hargreaves Lansdown or AJ Bell, then clearly you can minimize your fees by sticking to ETFs. Now, the actual fee you pay on those two platforms depends on how much you've got to invest. For small amounts, it may still be more cost effective to go for funds. As the amount you invest increases, it may be worthwhile switching to ETFs where the cap kicks in. But if I had to choose one over the other, and it was like desert island funds, well, I'd go for exchange traded funds because I think they're simpler. One fee on every platform is, I think, the best way to do things. And you can go for these platforms which are ETF only, where the platform fee is zero. Now, don't forget, if you did want to sign up for our weekly market roundup, You won't regret it, and it'll be quite entertaining. Then you can do that by going to our website, pensioncraft.com/newsletter. And you'll find a link to that in the description below. And, as always, thank you for listening.